Nilesh, what do you make of this complete collapse in the price of gold, below 1200 now internationally, and the damage that it's inflicting on the whole ecosystem of anything to do with gold, from Titan to jewelry companies to gold loan companies? They've all completely collapsed.
I mean, in some sense, these are two opposite forces which are working. The global correction in gold prices is more function of dollar strengthening, is more function of less risk aversion as the global economies led by US have started stabilizing. However, in India, typically lower gold prices should have resulted into higher gold buying, and we did see fair amount of buying happening in the month of April and May. Our gold imports almost doubled in April and May. However, post-May, government started taking several action on controlling the gold consumption, and along with the drop in international gold prices, even though rupee depreciated, rupee gold prices have come down. So combination of these factors, especially the government's proactive steps on controlling gold consumption, is resulting into gold stocks prices coming down. And I think it's necessary from an overall economic point of view. It's time Indians stops consuming gold like they were consuming just few months back.
Last we spoke, though, Nilesh, we did talk about how perhaps inefficient this method of attacking the rupee via the gold import route was. Since then, the rupee's gotten to 60 and today recovered a bit. Where do you see things headed for the currency market?
I think we believe if we see the long-term history of rupee, it always moves in a step and a ladder function. It makes a big move in a short period of time and then consolidates around that level. We think if we see the journey from almost 44 rupees to 60 over last 2 years, that's a fairly substantial move. It has kind of covered the undervaluation which rupee was having on a nominal basis, and now hopefully the new norm for rupee will be between 57 to 60. Above 60 is a overshot, and as Udayan mentioned, that hopefully traders will listen to his advice of not staying in an area where you are not welcome.
You track the bond market quite closely, Nilesh, as well. What signals are you picking up from there? Because it's got fixed income investors quite worried, because last few weeks there would have been some small capital losses. Is it still prudent to be in fixed income funds, or do you think something is changing?
From a fundamental point of view, bond markets have reached a trajectory where it is a buy. Interest rates have risen significantly in last month, and hopefully from here onwards they can start coming down from a just fundamental point of view. Liquidity is improving. Payment of oil subsidy in the next 45 to 60 days will improve liquidity significantly. Government surplus has started coming down, and overall banking liquidity is now reaching within the RBI's comfort zone. The second thing which is happening is that RBI has a lot of firepower left on open market operation. Compared to last year, this year they have done just than 25% of OMOs. Third, the demand and supply from a redemption and new subscription point of view is fairly matched. And plus this correction in yield by about 50 basis points is also giving good fundamental stability to the bond market. However, from a technical point of view, bond markets will have to face little bit of uncertainty, especially looking at currency market. Today, the bond market is rattled by the FII's outflow. They have taken more than $6 billion in last 1 month. If currency market stabilizes, then I expect bond markets to stabilize. And while the ability of RBI to cut rates is going to be restricted compared to what it was, say, a month back, we still believe that RBI will eventually cut rates in the rest of the year, and hence at this point of time it's worth investing in duration product and bond funds, but be mindful that in the near term there will be still some volatility, especially if currency market doesn't stabilize.
For another time, the market has managed to prevent breaking below its recent lows, Nilesh, but we're still trapped in that range we've had for many months now. What's your sense of what kind of turn the market may take from here? I mean, is it slowly gravitating lower and hence there is this much pressure, especially on the broader market? Or do you think now the poison is sort of draining out the system and the market could be cleaning itself to make a bigger move?
It's a very, very tough question. I was just looking at what was the small cap index when market made an all-time high in 2008 and what it is today. The small cap index is 5 times more lower than what large cap index is lower. So that kind of shows the polarization in the market. In some sense, it gives the confidence that at least the large cap index will continue to do well. But then when we see stocks which are leader in consumer, they are getting supported by buybacks rather than by the fundamentals. And even those stocks which have done extremely well in the last many years, moment they start underperforming in terms of their delivery, they've started underperforming the index. So I think the markets is going to remain highly polarized, and one will have to be far more stock specific than broad market oriented. This whole divergence between the mid caps, the small caps and the large caps, between the consumer pharma versus real estate and power and infrastructure, it's going to keep on creating a churn and volatility in the markets, and one will have to be extremely stock specific.
In your dialogue or conversations with global investors, Nilesh, what sense do you get of how long or protracted this entire liquidity adjustment process might take? I know it's a difficult question, but do you see it dragging on for another few months because of people now taking money back to the US and taking a dimmer view of emerging markets in the near term?
Again, Udain, here there are different versions coming from different sets of people. So if we speak with investors in Southeast Asia, which are more managing Asian flows, their outlook on the US quantitative easing being restricted or being reduced, they are saying that as long as India is doing well, we will put money into India. Very recently we concluded one offering for a company where we could collect money at a premium in spite of the market volatility. On the other hand, if we speak to Middle Eastern investors, again the focus is on how India will take care of their investments, especially their real estate investments and telecom investments is creating shadow in the minds of those investors. And if we can pull off the airline deal, then probably those doubts will start getting reduced and the flows can start. If you go to the European side of investors, their focus is far more on what ECB is going to do in terms of providing liquidity, and they are least bothered about what's happening on the US side. Since bulk of our flows come from the American investors, obviously they are watching Fed carefully. So effectively, if we have to sum up all these things, one, we have to remember that we are competing in a world where US probably is going to restrict its quantitative easing, but as long as we can run faster than Brazil, Russia, China, Indonesia, Turkey kind of peers, we will keep on receiving the flows. So we should not be overly focused on what US is doing. We should be focusing more on can we portray ourselves better than our peers.
Thank you, Nilesh, as always, for joining in with your thoughts. That's a view on the market.